Thank you for joining us for the CAR-W Thought Leadership Series. Today's program is entitled Commercial Real Estate Post-Pandemic. This is the second of 4 programs taking place on Wednesday afternoons at 1 p.m. Save the dates of June 10th and June 17th for our next programs, The Changing Retail Landscape and the Macroeconomic Outlook. This series is only possible because of our presenting sponsor, Landmark Credit Union.
Landmark Credit Union is honored to be the presenting sponsor for CAR's new Thought Leadership Series. Today, all CAR members, including brokers and affiliates, are affected by COVID-19. This challenge, like all previous ones, presents new realities and opportunities. For Landmark, we faced one reality that business lending would be managed remotely, but an opportunity to increase the use of digital signatures and contactless closings. Across the company, several innovations created to serve members had a positive outcome and will remain as permanent options. I am excited to hear about more creative ideas presented in the Thought Leadership Series from companies, industry experts, and economic analysts. I hope this series provides all of you with new opportunities that can be derived from today's reality.
We are also grateful to the 2020 CAR-W annual sponsors listed on this screen. Thank you. And now on with the show. To tee up our program, we've invited Andy Hunt, the director for the Marquette University Center for Real Estate.
Thanks so much, Tracy. It's a privilege to be here today to introduce our 2 main speakers. First, we're going to get started with Joe Lack. So Joe Lack is the chairman for CAR-W and is the director of the Colliers International Wisconsin Corporate Solutions Practice Group. So prior to joining Colliers, Joe was involved in the conservation side of real estate, working for the Conservation Fund in their land acquisition department. And in that role, Joe focused on tax credit allocation, zoning regulation, and acquisition of large-scale land tracts. In addition to his vast experience, Joe is also an alum of UW-Madison and is on the board of the UW-Madison School of Real Estate. And of course, our esteemed professor, the featured guest today is Dr. Mark Epley, the director of the James A. Graskamp Center for Real Estate at the University of Wisconsin-Madison, where he is also an alum, obtaining all 3 of these, his undergrad, his master's, and his PhD degrees. Previously, Mark served as the interim James H. Keyes Dean of Business Administration from 2012 to 2015 here at Marquette University, and as a professor of finance and Bell Chair in Real Estate. He was also the inaugural director of Marquette University's Center for Real Estate, and during his time at Marquette, Mark was also credited with creating the wildly successful Associates in Commercial Real Estate program, the ACRE program, which has helped hundreds of men and women of color to get into the real estate industry. Mark is an independent board member for the Federal Home Loan Bank of Chicago since 2012, and he is an immediate past president of the nonprofit Real Estate Research Institute, and also a very dear friend and mentor to myself. Now, I should say this is a perfect venue for Mark and for all of us for a lot of reasons. Number one, for those of us that know Mark, we're used to the extremely tiny charts that he likes to put up on big screens that somehow we still can't see. But hey, here, those charts are going to be right in front of our faces, which is great. And then second, of course, we get to enjoy that long blonde hair in all of its glory right in front of us. So with that, I will hand it over to Joe to get us started. Thanks, gentlemen.
Thank you very much, Mark. We're honored to have you here. So with that, I want to give a little bit of color on what it is we're going to be approaching today. So our discussion as a whole is going to be approximately 45 minutes, with the first 35 to be a moderated discussion between Mark and I on what it is Mark is seeing in the global economy these days. We would like all members, all participants on the call to please keep track of questions and start messaging those to Tracy throughout. We will take the last component of the discussion today and make sure that we can throw some tough ones past Mark as well. So with that, Dr. Epley, let's get started. These are absolutely incredible times on many fronts. We're experiencing a public health crisis first and an economic stoppage as well. These are collectively the likes of which we've never seen in modern times. You're an academic, you have a strong record of data and research. Tell us, what numbers are you watching today? What are you seeing as major indicators of where it is that we're headed in the future?
Well, thanks for the question, and thank you for the introduction, Andy, I think. Delighted to be here, delighted to be back with the CAR-W folks in Milwaukee and Wisconsin more broadly. So, of course, when you start looking at the data, there's two big numbers that we always follow up with when it comes to economic data. And Andy, I'm sorry to say, this is going to be a PowerPoint-free presentation from my perspective, so I'm going to talk through it. So what we really have is first-time unemployment claims over the last 8 weeks. Totaled 40 million civilian employees. So when you look at that, you go, how big is that? Let's put that in context. Well, we have about 164 million people who are in the job market in the United States, about half the people. That means 1 out of 4 in the last 8 weeks have put forth unemployment claims. That's terrible. That's a difficult start. From there, look at GDP. The other big measure is 70% is consumption. And I'll ask you folks online, how has your family consumed? Have you traveled? Has you dined out? Have you gone to the mall, seen a show? How about a Brewers game? Well, we can't go to any of those. And so what we're likely to see is a pretty big fall off in GDP numbers. Likes of what they're saying is 20 to 30%. Now, please know when you look at this number, this is going to be a quarterly number annualized. So it's going to be exaggerated a little bit. But to put it in context, in all likelihood, economists, and myself included, likely see a 6 to 8% reduction in GDP for the year. And the worst of the Great Recession, the year-over-year GDP drop was 3.9%. So we're going to have a tough year this year from economic growth.
Are there any other indicators beyond GDP and unemployment numbers that you're watching at this time as well?
Yeah, so kind of anything that leads, right? Anything from walking around your street, among other things. But a couple that I've really latched onto most recently are TSA screenings in airports. So, for instance, a year ago, this week, there were 2.5 million people screened. Last week, there were 353,000. So that's 14% of year-ago numbers. So that gives you a sense of how badly travel industry's been hit. But that said, from just over a month ago, from the week of 4/21, there were only 92,000 folks screened in the United States. That's a good way to start thinking about how are we getting back to work. From there, Uber and Lyft ridership data, they're up from lows. Additionally, one of the things I'm keeping an eye on this go-around, I spoke about the first-time unemployment claims. The continuing unemployment claims are at 20 million as of April data. Now you go 20 million, once again, that's a really large number when you put it in percent terms. Mm-hmm. But what's interesting about that, Joe, is 87% of those folks listed themselves as temporarily unemployed. So that's I think that's really important to take a look at that. First off, is that number going to expand or contract across time, or are all those people going to be coming back? So there's some really maybe good news with that. And then from there, how are consumers shifting their behaviors? I think that's still tentative, but it's moving. And overall, nobody wants to self-isolate. So how are we going to get out from under the rock that we're currently living in what are the ways we're doing that? So those give you a couple of things I'm looking at.
Fascinating. No, it definitely does. Looking forward as far as hope, are there any bright signs, anything on the horizon that you're seeing, any indices or indicators that are pointing the right way?
Yeah, so for starters, this is not an economic crisis. This is a healthcare pandemic that has economic implications. So I ask you all to think about that in those terms. When we look at the Great Recession, that was a financial crisis. So we have an healthcare pandemic pushing us into a bit of an economic concern. So let's start with the pandemic. So Dr. Fauci from the NIH said, probably by the end of the year, we're likely to have 100, 200 million coronavirus vaccines available. That's just in the last 2 days. If that were to happen, that's a game changer. You'd have people back on planes pretty quickly. Additionally, I already talked about those that high unemployment rate, but 87% of those are temporarily unemployed. I think that's a big thing. Additionally, in the short term, Joe, when we start looking at this and we start looking at the wage data, it's worth noting that the numbers that came out last week was that personal income grew 10% over the previous month. That's in April. And you go, that's kind of crazy. How can that happen? Well, personal income grew 10% while wages dropped 8%. So it is these programs like the unemployment benefits, as well as the $1,200, how shall I say,
Stimulus
rebate,
check?
stimulus
Sure.
check, thank you, that everybody received that really pushed that. And it's worth thinking about the unemployment benefits in the following way. So let's say you've got a $20 an hour job, which is about $40,000 a year. You're going to get about $9 per hour in benefits. So you're going to get about 50% of your wages in benefits. But remember that the unemployment override of $600 a week, which is part of this, that's $15 an hour. So individuals will be getting not their $20, but they're going to get 15 plus 9 or $24, getting paid substantially more for not being employed than being employed. I share that because they're going to have money in their pockets. A couple other quick things worth noting. The Federal Reserve was superb in their timing. As Andy noted, I'm on the board of the Federal Home Loan Bank. We were having weekly and even bi-weekly meetings and calls with Risk Management Committee and the board. Come about March 22nd, March 23rd, we were approaching crisis. And let me give you a couple of examples what that means. So what was happening in the institutional money markets were United States Treasury securities, the safest of all securities. Even short-term securities were trading at 3% discounts. Now, normally they trade at 7 or 8 basis points, and they were trading at fully 3% discounts because people wanted out of all securities and into cash. We had any number of board members on the Federal Home Loan Bank as well, having folks pull up to their drive-thru and say, I'd like, $8,000 or $10,000 of cash, pulling their money out and having those concerns. What happened, the Federal Reserve really stepped in right at the right time. They've been expansive in what they've done like we've not seen before. They've almost put as much money into this as they did across all the QE, which took 7 years, in the matter of about 12 weeks. They put about $3 trillion in, but it was necessary and it's working. Risk spreads on triple B and double B securities have gone to half. And so I think what they've done, I think what we've seen is the possibility of a crisis has been averted. The markets are functioning well and are liquid. So I think we actually have a lot of money in the system right now, which will help everything out quite a bit.
In light of that, do you think we kick the can down the road if we're not going back full force right now? Meaning that through the stimulus packages and basically bolstering consumer spending that way, that we just pushed it into the next few months?
No, I think what we really needed is we needed a stopgap now to make sure people could make their mortgage payments, their rent payments, among other things. We certainly are kicking it down the road a bit in that we're taking on greater deficit spending, and that'll have to be paid back in the future. However, I think we needed this at the current time. That's what you really have is stimulative spending in the downturns. And so, no, I think this was the right thing to do.
Great. So comparing what we're seeing right now to the Great Recession of 2008, we saw a credit crisis at that time, and real estate was profoundly impacted by it. Here, we have a true stoppage, if you will, over the course of the last 2.5 months. Would you speak to us about how those differ and how you think that will change the recovery curve of what we saw last time?
Oh, that's good. That's an interesting question. So a couple of things that are probably worth noting. And let's start with price floor discovery as for an example. So when we start looking back to the Great Recession, it took about a year for the transaction volume to fall by 51%. And what we're seeing right now, in the matter of about 4 to 5 weeks, 2 months, let's say, we've seen the transaction volume drop by 77%. What's really happening here is we're really we're going to hit that price discovery point very quickly for 2 reasons. One, we're getting to very low volumes quickly, and secondly, I think there's going to be a lot of money in the system, and I think we might talk about that a little later. But from there, when it comes to real estate pricing, let's talk a little bit about values. I think that's really important. So you go, going into this downturn, Joe, as you well know, prices were at all-time highs and cap rates are at all-time lows for about all property types, but for retail. And you start to go, well, gee, real estate was overpriced, or maybe even wickedly overpriced. If you now look at the relative pricing of real estate to, let's say, United States Treasuries, and one way to look at that is looking at where are cap rates relative to 10-year Treasuries, so long-term fixed rate risk-free bonds. And across time, cap rates have been a little more than 3%, 3.06% higher than 10-year Treasuries. What we see right now using NCREIF data is we've got about a 5% cap rate across all the markets, roughly speaking, which would mean we could have a 2% long-term Treasury to roughly be at equilibrium. As we all know, Treasuries, well, actually, Treasuries stepped up today, but they're at 70, 75 basis points right now. So we end up having 4.25% premium, suggesting to me, relative to other securities, real estate is really quite appropriately priced. I think it's actually in a pretty good place, even if Treasuries come back by a full percent. Then the second thing, when it comes to how things are quite a bit different from 2008, is liquidity. 2008, the Great Recession, was a financial crisis. Liquidity dried up. We saw big Wall Street firms fail, and there was a big shift away from credit risk. And what's happening in this one is there's been tremendous liquidity from banks to the Federal Reserve to Federal Home Loan banks. There's a fair bit of liquidity across the marketplace. Now it's a matter of, do you want to make loans in this environment? Additionally, if you look at the equity markets, I think there's a whole lot of, as they call it, dry powder waiting on the sidelines for some good pricing. What's going to happen, though, or has to happen, is we really have to get this price floor discovery, which we'll probably get over the next 90 to 120 days or so. And I think we'll start transacting in the last half of the year at rates that might start to approach what we saw 1 year ago. So I think we're not nowhere like we were last time, where it took a long time to come back from this credit problem.
Well, you're giving hope to a lot of real estate practitioners there, so that's great news.
Well, hopefully it's not false hope, and I don't care to do that anyway. So thanks.
So we talk about the debt and equity markets and the capital market side of the business. How about into the actual asset classes now? Typically we're breaking it out into the 4 of office, industrial, retail, and multifamily. What are you seeing as different trends in each of those these days?
Yeah, anticipating your question, Joe, I went to any number of sources, starting with Real Capital Analytics as well as CoStar and other data sources. Let's start with the 2 relatively easy ones. Industrial, we're seeing year-over-year transaction volume for April down 60%. But what we are seeing is most tenants are paying. And for those who are not paying, the landlords have some degree of leverage because the markets are relatively tight. And if you decide not to pay for long enough, I will find a way to replace you. So industrial's looking fairly strong. Apartments, let's take a look there. I think similarly strong, Joe. Year-over-year transaction volume off 71%, so that's way down. But an interesting one for you all to follow online here is go to the National Multifamily Housing Council, NMHC, and follow Rent Tracker. And what you'll see is this year's it's rent payment tracker, excuse me. And what they do is they follow 11.7 million transactions. And through May 27th, delinquency rates year over year for their portfolio are about up 1.5%. I'm in touch with a number of local operators in the Milwaukee area, and Class A properties are besting those of the nation roughly, with delinquency rates in total of about 0.5%, maybe a little higher to 1%, with Class B properties looking pretty much like the National Multifamily Housing Council numbers, increasing by maybe 2%. Let's go to retail. Hopefully it's not too long here. Retail and office. Hotel markets have been frozen. There are only 10 transactions according to Real Capital Analytics in all of April, which is effectively a frozen market. Let's talk about retail. Volumes off 64% year over year. It's most challenged. CBL just missed a couple of debt payments, as we all know. What they had was about 25 to 30% payment rate. Now that's for a mall. Malls largely have been shut down. What we're seeing using Datex data for April, there's been about 50% payment rate for national tenants and about 40% for non-national tenants. So probably not enough to make your debt service payments, but coming close. And hopefully we'll strengthen up and we'll start to, as we start to open things back up.
Certainly.
I think the wild card is office. Transaction volumes year over year off 60% there. But there's a lot of really big and interesting questions here. My personal belief is I think we innovate best in small, dense places where we have the ability to interact with each other. That said, the COVID virus certainly puts a dampener on that. But when we start looking at the future, you go, does working from home work? What about co-working spaces such as WeWorks, and how they're going to do social distancing? And then if we do want to social distance, Joe, what is the cost going to be? So in summary on that one, I pretty firmly believe that innovation happens in clusters, and it's far better to have live clusters than the one we have right now on Zoom. I think it's far better. Also, I haven't met a single person yet, and maybe there's some out there, that believe the self-isolating is a good thing. We want to get back to work and back at it. I believe office will do fine, but there could be some CapEx involved.
Certainly, certainly. How about affordable housing, workforce housing, maybe even more so? That was such a topic of discussion, specifically in Wisconsin and in the Midwest. Do you see that drying up? Does that stay? Does that come back quickly? What are your thoughts there?
Not as good a data in short order. In short, as we all know, in the state of Wisconsin and nationally, we have a shortage of new housing, and certainly for affordable housing in particular. So I don't have much data, but there's a continued demand for that type of space. When we start looking at maybe urban versus suburban housing as well as other things, you go, will people shift more to suburban? Yeah. I think there could be a temporary movement that way, but I start analogizing this to kind of 9/11 or 9/11, I should say. We didn't really want to go to big office towers, but you know, after we took care of the problem of people breaking down, let's say, cockpit doors and people possibly coming in with bombs, hey, I guess what? We then got comfortable going back into those towers again. I think we will still stay dense, and in the downtown will stay the preferred venue. It's hard to say that right now because downtown is equals dense, and dense right now equals COVID concern.
Right, right. Let's pivot over to entertainment. Consumer spending. You know, clearly, we've had mass cancellations of all larger gatherings. What do you see on that front? What sort of economic fallout from a spending standpoint do you anticipate? Yeah,
that's a great question. As we all know, Summerfest has been delayed, limited NBA season. It looks like it's coming back as of today. Limited MU season. It's hard when it comes to some things, entertainment. That said, I think it's worth, again, analogizing maybe 9/11 to the current. So after 9/11, President Bush got on the TV and said, "We are Americans. We are strong. We're not going to let terror get the best of us." And he effectively is saying we've got to go out as Americans. We got to go out and spend and travel and do the things we've always done. Great. So to be patriotic, that's what we needed to do. Now, with a pandemic, to be patriotic means we should stay holed up at some level. Others might think patriotic means go out and spend. I know there's a difference there, and that might run along political lines. I don't care to get into politics in that way, but there's some degree of belief that staying holed up is being patriotic. So how quickly we as consumers come out of that hole will be somewhat difficult to guess. That said, as you start to look at what retail was really going to, when you look at what malls are trying to do, what the real spin is, it was around creating an entertainment environment within the sale of other soft good products. So it's all about entertainment. In all these malls and in other places, we're shifting to more of an entertainment show or entertainment focus. Now we're saying entertainment's bad because that means people are getting together and not staying 6 feet apart.
Right.
I think that too will come back and find a good place, and far more quickly than we might expect. We really do miss these things. You know, think about that. You know, that great burrito at the corner taqueria. Well, it's really all about the daiquiri or the margarita. But anyway, but it's those kind of things where we really do want to see those things come back, and we will get back to that. And I think far more quickly than we might otherwise realize, especially with the likes of a vaccine on the horizon.
Absolutely. So continuing the theme of kind of drilling down into some specifics, loan forbearance, rent deferrals, force majeure have been buzzwords of the last 8 weeks. Negotiation of them, back and forth discussion about them. From a macro standpoint, are you seeing any trends develop around those, or is it still anecdotal information that's being shared on kind of a case-by-case basis?
Yeah, quickly around industrial and residential, multifamily, largely rents are getting paid or collected. They might be a little late, but by the end of the month, most of the rent comes in. So on a large macro basis, that's doing okay. I think I shared with you earlier about the retail where 40 to 50% of the non-national and national tenants paying rent. That said, any number of national tenants are flexing their muscle. So a good example is I was talking to a developer in Minneapolis. He's got FedEx as a tenant. FedEx says, I'm not going to pay rent the next 3 months. Hey, I understand. You can get a rent abatement for 3 months. I'll work with you on that. No, I'm not going to pay rent. Well, I can just simply, you cannot pay rent for the next 3 months, but let's add it to the remaining 4 years of terms. No. And so what's really happening is some of these larger tenants are realizing the retail market in particular is weak, and they're flexing their muscle even with these contracts in place. So that's a bit of a problem. And the problem is some of these retailers aren't receiving income either. And so when you start looking at retail, a health ratio, which is really sustainable occupancy costs divided by sales. So you can have about 10 to 12% of sales going to occupancy costs. They're not seeing much for sales. So I think we'll have to recalibrate and come back from that in some way.
Sure.
And it could take some work. And I think the softness in the retail market will really make for some big headaches. As far as force majeure came up, was a big topic and faded away as most found that it probably wasn't enforceable. At least that's what I'm hearing. Not in the legal world real closely, so I might not be as up to date as some of the folks on this call.
Sure. So looking forward, you spoke on this a little bit at the beginning of our conversation, but pulling out your crystal ball, what do you think a quote unquote recovery will look like? Be that a timeline, be that a price correction, be that kind of a return to what we'll call a new norm. What do you foresee on that side of things?
Yeah, so first off here, Joe, once again, the risk here is a healthcare risk in a healthcare pandemic, and it's really going to be a function of when that pandemic clears and how it clears. Best of all worlds is It's starting to clear now. It continues to clear. These riots and these folks who are out for the Floyd protests, they're clearly not 6 feet apart. Hopefully there will be nothing come of that from a COVID perspective. So COVID could go away like any other cold or virus across the season, so to speak. Doesn't look that way based on what I think the medical profession is saying, but we could have like I say, it all depends upon that. In short, presuming we don't have another big flare-up come fall, I think the desire for consumers to consume, if you look as well as the savings that happened, our savings rate went from 8%, Joe, last month to 33%. So some of that stimulus money actually went into people's checking accounts and they're holding on to it. That's dry powder for spending in a future day. And if you start looking at what happens from a spending perspective, and there's been a lot of research done on this is a little bit of a tangent, big sports arenas create additional spending? And for the most part, that can be pretty limited, because what happens is we have a certain amount of money we spend on entertainment. And if I spend it in, let's say at the Fiserv Forum, it's substituting for not spending it elsewhere. So what's going to happen, I think, is people are going to come back and they're going to spend like they did before, because we need to go out and we need to be engaged.
Great. Mark, with that, we've got a couple of questions that are starting to come in from the audience as well. One that came in first is hoping for some insight from you on inflationary concerns over the coming years. Clearly we've had quantitative easing, the likes of which we've never seen on a federal level before. You still have the spread over treasuries that you were referencing before. How does this all play together? What should we anticipate in the next few years?
Wow, great question. And what happened after the Great Recession confounded many economists. So what happened after the Great Recession? We had all this stimulative spending. Many economists thought inflation was gonna take off, and it didn't. And well, it's coming, and it didn't. And it's coming, and it didn't take off. And we're starting to look at things a little bit more like maybe the Japanese, where we don't quite have the solid economic growth we could have in the 70s and 80s. And mainly, we don't have that solid economic growth because we don't have growth in our jobs market. We had women entering the workforce in large numbers in the 70s and 80s, as well as immigrants. We're limiting both those. We're not going to have great big demand pressure to push prices up. And then we have supply pressure. That could be a problem as our supply chains are getting damaged, both by our trading that is or isn't happening, or as that is changing, that we could have short-term supply limitations. Overall, it appears as if inflation will likely stay constrained, but I fully appreciate the questioner's question, because in 2020, we're going to add $4 trillion to the federal deficit. $3 trillion for the stimulus and $1 trillion because we have structural deficits. That has to get paid for somehow, and inflation is a possibility. Based on what we've seen most recently with the Great Recession, and what most economists believe, is that inflation will remain fairly tame. I tend to lean that way as well.
That's certainly good news. How about the volatility in the stock market these days?
Yeah, great question again. So we all invest in the stock market at some level, or most all of us do, and if not directly with our after-tax money, with our 401k money. All in all, most of us are investing for retirement, and hopefully we don't care about the noise that we just saw over the last several months, because we're investing not for a year or 5 years, we're adjusting for 10 and 20 years. The volatility, in the end, if it stays volatile and comes back, increases risk premiums for all asset classes. And as you increase the risk premium, you increase the cap rate. I need more rate of return per a dollar invested. And when that happens, that hurts asset pricing. So to the extent this risk will stay in place in the stock market and it flows over to other risky assets, AKA real estate, that will hurt real estate and asset prices.
Sure.
I think what we're seeing though is we've seen the market bounce back rather nicely, and is actually a concern to some that we've almost forgotten about the COVID concerns.
We haven't touched on healthcare real estate at all. You know, we touched on some of the other major food groups, but a question came in from the audience about, with healthcare spending having changed so drastically, so abruptly, many healthcare systems are looking at years that they never anticipated or expected. So how does that affect healthcare projects and healthcare real estate as a whole? Any thoughts there?
Yeah, some quick ones. So one would think this pandemic has really helped out the healthcare industry because all these folks are ending up in hospitals. Well, they're actually ending up in a narrow slice of hospitals, usually in dense urban areas. But what's also then happening is all the scheduled surgeries in other visits that were necessary didn't happen. Look at dental. People don't go to dentists. So when you start looking at one of the bigger unemployment increases in the United States, it was around healthcare workers, actually. You go, really? But then you think about it, you go think about all those in primary care facilities, all the dentists and dental assistants and so forth. Vast majority of those folks were laid off. So actually healthcare systems have been hit pretty hard by this pandemic because it's not helping what their normal business is. As such, they could have a step back for a number of years to recover from where they were, or start to reassess this new risk that they're living in. And could this happen again? And it could certainly happen again. And how risky is that? And how do we want to grow our businesses? I think they will be rethinking their business model for these types of adjustments, and they're not going to be easy. So again, from a healthcare business perspective and ultimately real estate perspective, that space probably got riskier, actually.
Definitely. That's the way it seemed on the surface. I'm fascinated to hear your take as well. Another question that came in that I think is quite interesting is related to just general land use patterns. You know, you're seeing a flight from dense urban cores. Does that pop up as just a temporary thing as folks are leaving the likes of San Francisco and New York City and moving out just for temporary safety? Or do you think that this is actually a trend that may stay?
Oh, that's a great question, because what we're seeing is from an urban economic perspective, and as I teach some of this in the classroom, we're seeing that places like Silicon Valley have become just unbearable to live in. What you really want in a community is to have the butcher, the baker, and the investment banker and the technology expert all in the same neighborhood. But in so many of those neighborhoods, the teacher can't afford to be in that neighborhood, the policeman can't afford to be in the neighborhood, and the neighborhood changes completely. The average house price is $1 million, can never own that home. So folks are leaving some of these areas for other cheaper or more reasonable places to reside. That seems to be accelerating out of the likes of Silicon Valley, separate from the whole COVID thing. That said, what we need if we want to accelerate that in Milwaukee or other places in Wisconsin, we've got to figure out how do you have a cluster of those industries in your city so that both employers and employees know that there will be employee options if you're an employer, or employer options if they're an employee. And so what I'm trying to suggest there is that you need to have a critical mass of folks of those different industries. So yes, folks are starting to move out. Regarding the COVID issue, I believe that will be a passing concern and not a big deal. But one plug I want to make though is around and have everybody start to think beyond. Walkability is really quite important from a density perspective, being able to walk someplace. Well, we then switch that to an Uber distance. And Uber distance is not about distance at all. It's about the cost to go from where you are to where you want to be and how quickly you can get that Uber. And in 6 years, maybe less, maybe even 5 years, it's going to be autonomous vehicle travel. There'll be more vehicles out there. There'll be 40% the price of what Uber is. And it's going to change the rent gradient and the willingness for people to maybe live a little further away from those main streets. We might have a dozen different main streets in the city of Milwaukee, in Milwaukee and area, that you can live a little further away and quite comfortably get on an autonomous vehicle and have it take you where you want to go and take you home, and they're always going to be there. I think it's going to be a game changer from an urban land perspective.
That is absolutely a fascinating study, and I think that's one of the implications of autonomous vehicles that probably wasn't anticipated day one.
Yeah, think about what that will do to make you to allow you to easily travel, cheaply travel from one place to another, and then also you have what do you do with the parking structures, because we're not going to have the cars.
Sure.
And it's coming in. I don't want to say in our lifetime. It's coming in the next decade, and I'm guessing to say in the next 5 or 6 years.
Fully agreed there. Dr. Ripley, a question came in on the absence of CMBS debt in the market these days. Your general thoughts?
Yeah, couple of things worth noting. So I'm going to start by talking about leveraged loans. And leveraged loans are loans that are made generally for rehab properties that someone like a TPG or Blackstone or others might make, where they're borrowing, let's say 70% of that money from a bank and topping it up such that a borrower could then get an 80% loan to value, where a bank lender might have only given 65 on a rehab. That leveraged loan market is tightened up and almost gone away right now. It was a little bit at risk, and the pricing was getting really skinny for those deals, and I think some of those investors are getting hurt. That said, this could have been a loan-to-own program by the likes of Blackstone, TPG, and others. In other words, they're lending that money, and if it all pays off, fine, I get my money as expected. If it doesn't pay off, I own the real estate. That's not a bad outcome either.
Right.
So the model could work maybe either way. Onto the CMBS market. The CMBS market, the risk spreads have widened out dramatically on the securitized debt against real estate, pools of commercial real estate loans, making it very difficult to price a loan that is to reasonably price a loan. In other words, interest spreads are far too wide to make sense of it, keeping most out of the market. Also, if you think about the process of a CMBS loan, what happens is you've got 5 or 6 originators, big firms that are originating loans for someone who's warehousing those loans for 3 to 4 to 5 to 6 months while they're creating a big enough pool. And while you're warehousing those loans, it's very difficult to manage the the credit risk on that pool. If spreads widen, they're really hurt. They narrow, they do really well, and so it's really the securitizers and those who are pooling. You need a really big return, and so the level of disruption and spread widening and spreading and coming back in, and then also now some support from the Fed in that space. It's really, how do I say this? It's created great disruptions in that market, and it'll take another couple of months, maybe even longer, a couple of quarters, for that to settle down and spreads to come into a reasonable place again.
You anticipate though that it will? Over the course of the next few months, you will see some normalcy returning?
Investors chase risk-adjusted yield, And at one point, if the adjusted yield, the risk-adjusted yield is appropriate to invest in CMBS pools, they'll start doing that again. I think that'll come into play in due time. I also don't think we have a real estate crisis here at all, but we do have some concerns around hotel and retail. And if you start limiting those two groups, the other property types will probably do okay. And so that then manages that downside risk.
Fair. Do you anticipate that we will see foreign investment increase or decrease post-COVID?
Overall, we are not doing a great job on the policy front internationally. And again, I don't wish to make this political one way or the other, but when we start looking at our international friends and investors, we're becoming less and less liked by the international community. As that starts to happen, makes it a little harder to invest in the United States. That said, we're still a pretty good safe haven. And I think on a relative basis, our real estate is probably more cheaply priced on a chunk basis and on a yield basis than the likes of Europe and many other countries. The cap rates in many countries that are not anywhere near the risk profile of the United States have cap rates that are at or below US cap rates. So we could have capital flows coming in.
Sure.
I would not expect that. I think we're starting to see a time where that's going to settle down some. That'll hurt us a little bit.
Sure. Dr. Epley, we want to be respectful of your time. I have two last questions, if we may. I would love to run past you. One came in from the audience regarding college attendance in fall. And certainly from your role at UW, you're going to have a purview into it. Do you anticipate globally we're going to see more of a return to on-campus studies in fall? Will it be kind of an amalgamation based on the university and the type of programs offered? What can we expect there?
Yeah, great question. Just had a call literally till 12:45 today on that very issue. What you're seeing are a couple of different models that are happening with Notre Dame, USC, and any number of other schools where they're going to start school 2 weeks early, and at Thanksgiving, they're going to be done to prevent the possibility of bringing a COVID back to campus for those last couple of weeks of the semester. When you start looking at things at the UW, by the way, this is only Mark Epley's view, but this is what we're starting to hear. It appears as if the big lectures will stay online. The small lectures will be in class. The small lectures will be in class where there'll be an ample amount of social distancing that can happen. So it'll probably be some sort of a hybrid model at the University of Wisconsin would be my best guess at this point. It's a very important question, by the way, for universities as well. And less so for big state universities, but a lot of the private universities, and maybe including the likes of Marquette, there's a fairly big portion of the net surplus or profit, if you want to call it, that those universities get from the housing. And if you can't bring your students on campus for the housing, it will create a whole cascade of financial problems for some of the smaller universities. And I don't put Marquette in that group, but they're those smaller liberal arts schools that are not very well endowed, smaller being 2,000 to 3,000 students, where Marquette is a diversified university with almost 12,000 students. But it will create some financial challenge for any number of universities. There will be failures.
Definitely. That I mean, to be expected when you're removing the students from campus at that point. So
Right.
Last but not least, we'd love your input. You're speaking to 150 plus real estate professionals all over the state of Wisconsin. Pull out your crystal ball. Where do you see opportunities in the months and years ahead?
Okay, so opportunities come where greatest disruption is. And greatest price changes happen. When you start looking at the multifamily and industrial spaces, those will have and are having minimal disruptions and will come back to market pretty quickly. I think when you look at the multifamily, was on a call with the National Association of Home Builders Roundtable, Bob Dietz, and then it was confirmed in the news as well that they're expecting a 30% decline in single family home starts this year, which means that that more folks will probably end up maintaining years in apartments, meaning in the long term, that will probably be fine. Industrial will likely be fine. The wild card, an interesting one, if you can position it well, would be, I think, office. Offices might take some CapEx, and that CapEx can sink you really quickly. You all know what it is, from tenant improvements to other things to make those facilities suitable for the next generation of space users. And repositioning retail would be the other real disruptive opportunity I think that's out there. I don't think any of those are surprises. Sorry, I don't have anything sexier than that. But the retail space was being shifted towards entertainment, and will those entertainment venues be able to maintain will they be able to stay open? And for the what might be a cascading loss of retailers nationally, if you've got a great thought for an alternative use for some of those spaces, I think you'll be in good stead. So those where the opportunities are, but that's also where the risk is.
Certainly, certainly. Well, with that, Dr. Epley, thank you. Sincerely, thank you for taking the time. Thank you for sharing your insights. On behalf of the organization as a whole, we have immense respect for you and what you've done, and we appreciate your time immensely.
Well, great. Thanks for the opportunity to chat with your folks. Hopefully it was helpful to how you do your business. And thank you for your interview.
Well, I personally found it that, and I'm sure our membership base does as well. So thank you for that. And to everyone on the call, thank you for joining today. We hope you'll be able to join us in the coming weeks. Next week, Wednesday, we have our next thought leadership course with Dan Klein of the Motley Fool. So he's got some big shoes to fill here. But thank you very much, everyone. Have a great day. Stay cool.
Bye.
Bye-bye.